Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jon Ferro, along with Lisa Abramowicz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
Pelosky of TPW Advisory thinks the rally can extend, writing this: "We are optimistic not only about 24, but the out years as well, 25, 26. Our analog remains the US 1995 to 1999 period. The difference is, this time, it's global." Jay joins us right now. Jay, good morning to you.
Good morning, John.
Does the economic data in China back some of that up this morning?
It sure does, John. I mean, I think it's clear to us, at least, that, and it's not only the data, right? We wrote a piece on Friday, our Friday Musings, called "Listen to Stocks, Not Vox." And we want to pay attention to what the markets are telling us. And it's not just stocks. It's also credit outperforming the ag, and it's commodities. And commodities, I think, right now are the big tell. Commodities, and it's not just energy. It's not just gold. It's not just copper. It's all of it. It's ag. It's all breaking out. And that is telling us that there is an opportunity and that the global economy, as we've been saying since the fall, is early cycle.
Soft commodities as well, seen it in cocoa, but
absolutely.
A lot of people might say that's a supply side story, not demand. How would you frame it?
I would frame it as both, and that's perfect. It's both supply side as well as demand side. And the fact is that most people have not been investing in commodities, and the demand has been weak, and they've been okay. And now we're coming into a point where that lack of investment, which can't be made up quickly, is going to bite. At the same time as a global economy, we think, is setting up for a considerable period of good economic news. And that combination, and the fact that very few people are invested there, very few people understand that commodities are the best performing asset class in the world year to date. Everyone wants to talk Mag 7. Mag 7, Mag 6, Mag 5. Commodities, people, it's really basic. It's supply and demand. You don't have to figure out AI. It's just simply buying the stuff that people still use.
How much does hinge on China, though?
Obviously not very much, because China has been a weak story, and commodities have done well. Markets move first. That's the thing that we have to remember. They're forward-looking discounting mechanisms. They know more than you, me, even you, John.
I'm shocked.
And therefore, they move first. And so commodities are, world's best performing asset class, when now people are just starting to think about China. Okay, PMI is better than expected. JP Morgan last week raised their Q1 GDP estimate to 6.6%. Okay, so you're talking about second biggest economy in the world, looking like it's starting to pick up, and that is obviously bullish for lots of things, including commodities.
A phrase we heard repeatedly, I think, over the last year regarding that region, that part of the world, was uninvestable. And I guess the caveat around that is it depends what you're investing in to get exposure to it. There's a great quote in your recent note, and I'm going to share it with our audience, and I want your thoughts on it. We note the discrepancy between the China tech stack, one that will increasingly have all of China to dominate. That's a really important line. Can you just build that out a little bit more?
Yeah, first off, on that uninvestable line, I also wrote a couple months ago, pro tip, when you hear uninvestable, invest. So that's point A, because it can't get any worse. Can't get any worse than uninvestable. But yeah, I think this point about the tech stack is really, really interesting. There are a lot of things setting up to create a big opportunity. And let's remember that markets have already moved in the US in tech, et cetera. So we want to be looking for the new areas of opportunity. And that's why that multi-year positive framework allows us to go from point A to point B to point C, et cetera. And that's what we've been doing in our model portfolios. The tech stack story, look, we've been trying to freeze China out of the advanced technology. We're doing a pretty good job. They've got the message. They have to build their own. They're now turning around saying, okay, fine, you can't play in our tech space. And therefore, the question is right now, do you want to be invested in a market of 1.4 billion people, growing at 6% per annum, with an e-commerce market that's double the size of the US, 10 times the size of Japan, and trades at a 70% discount? Alibaba trades at 8 times earnings. Tencent trades at 14 times earnings. China overall trades at 9 times earnings. Okay, no one owns it. I think it's a really interesting story. And the segue, flip your Mag 7 into KWEB, which is the China Tech ETF. KWEB can double and double again and still not get to the level it was in 2021, John. 25 to 50. The 2021 high was $101. I mean, that to me is a no-brainer. And we full disclosure, we own it.
Peter Tchir of Academy is going to join us later in the program in the next hour. He's put the emphasis on made by China. How important is that phrase going to be in years to come?
Yeah, I mean, I think we're big believers. Our name and our firm, TPW, stands for Tripolar World. Our whole thesis, our framework is regional integration in the 3 main regions of Asia, Europe, and the Americas. All of this stuff is happening kind of as one would expect. Supply chain regionalization, tech stack, independent development. Everyone needs AI. Everyone needs the climate proof. Everyone needs everyone needs electric vehicles and batteries. And these are the things that are driving that regional integration. And look, I think China is in a much stronger position than people give it credit for, because the region that they're in, that they're going to dominate, is ASEAN. ASEAN is the biggest, fastest growing region and will be for the next 10 years.
It's striking that you have such conviction in China when what we continue to hear from Washington is that they're just going to up the ante. Right now, they're weighing whether or not they're going to sanction the chip makers around Huawei's entire production. How much does that concern you?
Yeah, no, there's a race, right? There's a race going on. China's racing to get itself kind of independent, and we're racing to freeze them out of this stuff. And I think the point that we see is that the U.S. trying to freeze China is already in the price. Everybody who doesn't want to invest in China because they're worried about U.S. sanctions is already gone, long gone. And they're not going to come in. Fine. We don't need them to come in. Again, KWEB can double and double again. I'll just take the first double from 26 to 50 and leave the second double to somebody else.
So a 60% tariff wall for Chinese imports doesn't matter?
Yeah, sure, it will matter. Markets will sell off depending on where we go between now and then.
But I mean, if China is going to build within their own ASEAN.
Yeah. I mean, I would look at what China's done over the last 30 or 40 years, and I don't think we'd want to bet against their ability to kind of construct what they need to construct.
So when everyone else said uninvestable, you got bullish. When you say no-brainer, does that make you uncomfortable? What are the risk factors you would acknowledge exist around this bullish thesis?
For China?
Yeah.
Clearly what Anne-Marie said is one. I mean, if we come out, if the former president wins, which, as I've said on this show, I believe Biden will win on a landslide. But if the former president were to win and were to implement the tariff structures that he's talked about, that's clearly going to set the Chinese market back. But by the same token, as we advance to that point in time, China's own internal dynamics theoretically should get better, right? The property market should be better dealt with. The focus on domestic consumption should be moving further down the road. So it's not a zero sum. And how that all plays out, I mean, we have the ability to change our mind and to adjust our positions, and so we'll look at that when the time comes. But I mean, that to me is a big worry, because I think everything else is in the price. Alibaba, and no, it doesn't grow as much as it did before, but as the prior guest said, same is happening in the U.S. tech space. Earnings acceleration is coming down. Same as in Alibaba. The other point is that these companies in China are just like the U.S. companies. They're cash-making machines. They are buying back stock. They are paying dividends. And so, 8, 9 times earnings, I think the risk-reward is some of the best in the world, because the risk is already in the price and the reward is starting to materialize.
I'm sure this morning you've managed to convert a few non-believers for a tactical trade. What's interesting about your call, it's not just tactical, it's not 2024, it's 2025, it's 2026. Why has this been extrapolated out? It doesn't sound like this late cycle story from your standpoint. It feels much, much longer term.
Yeah, exactly, John. And, we put out a piece, our 2024 outlook, back in the beginning of November, so 5 months ago. The title was Surprise, Surprise. We had 4 macro surprises: lower inflation sooner than expected, better productivity growth, return to stability, and early cycle. All those are playing out. In particular, the return to stability argument. Look at the VIX. look at the move, look at the Fed. With all respect to the lineup of Fed speakers, I pay virtually no attention to that anymore. That is not the story.
We've just had an 8-minute conversation, and that's how long it took to mention the Federal Reserve in your whole thesis.
Yes, and that's exactly right.
Why is that?
Because it doesn't matter. The important thing is that the Fed and markets are in sync after being out of sync, right? 6 rate cuts in December, now, and Fed at 3. Now we're both at 3. And guess what? That happened without a ripple of market unease. And that tells me that's one of the things that tells me that this market is a strong market. And so we have, in our view, we're early cycle. We've made a return to stability. The Fed is our friend now, right? Can cut, as you were talking about, with labor worries. The Fed is our friend. The rest of the world is picking up. And so we look at 2023 to 2027, that body of time as being very much akin to 1995 to 1999, where you had productivity-inspired growth, you had lower inflation, you had good earnings growth. The difference, as you quoted, is that this time it's global, and it's global because of this tripolar world materializing and the fact that everybody has to spend on AI, on climate, on semis, on electric vehicles. And so you're getting, in our view, a much more stable globe because you're not dependent just on the Chinese consumer or on the US. You now have 3 centers that are going to be growing independently of each other. And so really the question is, who balances best private and public sector, because you need both, because these are huge, huge investments, right? These are like, game-changing investments. And so who manages that best? And that's one of the reasons why we like Europe. And you and I have been talking about this for years. But Europe has more experience than any region in getting everybody around the same page. One can argue they didn't do it well and it takes too long. But, look at the US and Congress. Right? I mean, no, not really an example of great governance. And look at China, stumbling after a really good run. So I look at ASEAN, and China dominates ASEAN, fastest growing region of the world. We want to play there. We look at Europe integrating, being forced by conflict to integrate, right? Multiple countries spending together, raising debt together, so you're going to see that capital market integration. And then we look here in the Americas and we see Mexico, which again, we've been overweight and invested in for 2 years because it is the flagship for the tripolar world thesis. Biggest beneficiary of what's going on in the Americas. We were invested in Poland. You and I talked about that last time for the European thesis as well. Yep. And we're invested in China for the Asian thesis. And so to us, it's an exciting blue sky period ahead. And the fact that most people are not there, people have kind of gotten onto the tactical trade. I mean, 27% in 21 weeks. If you're not on the tactical trade, you're probably not working anymore. But, to us, the good news is that we are, we see the process moving for multiple years, and we're still early in that, and others are going to come behind us. We're already double-weighted commodities, and we have been for 6 months. And so we're just moving from point A to point B and onward.
This is some super bullish stuff. Just remind me never to book you for Fed Decision Day. Okay? Jay Pelosky at TPW. Tchir of Academy Securities saying he's ready for a rotation. He writes this: I'm so sick of hearing about the Mag 7, Fab 4 or whatever. His words, not mine. And that it is time, at the time of the 22nd all-time high for the S&P 500, I'm looking for anything to steer me away from that. The Russell 2000 suddenly outperforming is interesting. Pete joins us around the table for more. Pete, good morning to you.
Yeah, good morning.
Is it more than just interesting? Is it the real deal?
I'm not 100% sure, because I've been kind of thinking about this market as really AI. Anything that's kind of been deputized into AI has been driving the market. But for the last week, all of a sudden, the Russell 2000 is a little bit better. I've liked the energy sector in particular. And I'm wondering now, people are starting to say maybe banking's okay, commercial real estate, biotech's had its ups and downs. So we could see a rotation. Unfortunately, I think this time, unlike November where we saw the rotation with strong gains for both, this time I think we might get tepid gains in the Russell 2000 and a small pullback in the NASDAQ 100.
Yeah, your words, and I think they're interesting, they're important, powerful words. Is the rotation more about losing less or making more. Which one is it?
I think it's going to be about losing less right now. I think where a lot of the froth is, where things are overextended, is really in that NASDAQ 100 type stocks. And if you look at it, it's really unchanged in about a month, month and a half. So it keeps coming up, and maybe it's a new high, but barely, unlike maybe the S&P. So I think there's room for that to kind of topple a little bit as people question, have we overextended on AI? Listen, AI is going to drive the future. The questions to me are you getting enough value at today's technology level, at today's pricing? And I'm not sure everyone's getting that. So if you see a pullback there, it's going to be the Russell 2000. Plus, people are looking where to put money that's not at all-time highs or really high PE ratios.
I'll ask a question, too, that I asked to Lori Calvasino, who is seeing potentially the signs as well of a rotation. We've had so many rotationary false starts. What makes you have the conviction that you think this could be it?
Well, again, I think we go back to the fall. We had a 22% rise in the Russell 2000 versus an 11 in NASDAQ 100. So that's, a 10% outperformance. That's the sort of thing I'm looking at. I think people are getting tired with the same story. Okay, I've already fully committed to AI. Where am I going to put my new money? And you start looking for value. You start putting money elsewhere. You've seen energy do very well. Mining's doing well. So I think that starts leading the way. If banks can stabilize and we get bank earnings next week, the regionals do well, that really pushes nicely there. And that's what I think drives it.
Jay Pelosky was also talking about energy. You like mining. He also liked soft commodities like agriculture. So you're just seeing the entire commodity landscape push higher?
I'm more in the hard commodities. I think for me, energy's been really the big focus because how I've been looking at it is it feels like we're finally understanding if we want sustainable energy, we have to build up sustainable energy more rapidly. So that's going to require a lot of commodities. But we also, for the first time, I think, understand we need real traditional energy for the next 20, 30 years. So that's going to be built out. So that's why I think that hard commodity energy is better. I'm not as sure about the ag stuff, though I would not touch cocoa, for example.
Are you doing this through equity exposure or directly through the commodity market? Which one?
I prefer the equities, I think. Again, our story for the last 2 to 3 years has really been that the energy companies of the future are the energy companies of today. People kind of tossed them out the window a few years ago saying, oh, it's all going to be about wind farms. It's all going to be about this. And people are realizing the traditional energy companies have the resources to provide energy today, but the skills to figure out how to provide energy in the future. I think that's where the big bet is still.
Started to see that in March. Started to see energy pick up, I think, by about 10%. Really solid month of gains for energy stocks on the S&P. Likewise on the banks as well. You've got an interesting take on the Federal Reserve. We've heard echoes of this over the last week following Chairman Powell. Well, they haven't officially changed their target. They seem to be willing to ease monetary policy even while inflation remains closer to 3% than 2%. What is 100 basis points between friends? What does it change in this market?
So I don't think it changes that much. I think, again, we saw the market priced out. I think we started the year at 6 rate cuts. We went down to as low as 2.5. And the market did fine because it's all about growth. So I think we can manage around that. But I think there's a little bit of froth, and maybe it's deserved, as you see Powell kind of shift his narrative to things that allow him to cut, right? No one's talking about the market doing the work for him. Remember back in November when yields were high? Now the market's undone all the work for him, and no one wants to talk about that. So it feels to me they're constantly looking to pivot to some excuse to be easy, which I understand. If you're the person in charge of the Fed, you probably don't want to be the one who drives us into recession, so you're probably slightly biased easy, and now he's figured out a new rationale for that.
Do you think the Fed is actually working against the market, or rather the market's working against the Fed? Because the Fed seems comfortable with stocks at all-time highs and credit spreads that are super tight.
I think we're okay-ish right now. I think there's kind of a decent balance, right? No one's going crazy. We're not talking about 4 or 5 cuts this year. I think we are rightly saying it's probably the end of the hiking cycle. Though, having said that, right, as some of this data comes through, and if I'm right on some of the commodities, we might see a bit of a resurgence. And the other topic that's coming up a lot is, as we're saying, oh, inflation's coming down, I think people are questioning, did we ever really manage to monitor inflation for the last 3 years? Are we heavily understating? Because you go into the stores and it doesn't look like things are up 3 or 4% per annum. It looks like they're up 10% per annum. So I think people are questioning some of the actual starting level from this decline.
If the Fed is trying to find any excuse, to your point, potentially to cut, what could they use, say, in June? Say they really want to cut in June, but inflation is still on this path where it's not exactly where they want to be, like the end of last year, but it is moderating. Is that enough?
I think it could be enough because I think, one, they'll just say, listen, it's long lag times and we've got to get a little bit ahead of this. And I think behind the scenes, if they can avoid cutting in September, November, right into the meat of the election, they prefer to do that. So I think you're much better off. If you want to get 2 cuts done early this year, you do it June, July, let the markets kind of adapt wrapped with that, and then the next one maybe comes in December if we're still there.
John asked a question earlier to a lot of our guests. What's more important, the payrolls number on Friday or inflation next week?
I think it's ultimately the payrolls. I think the market's been driven much more by the growth in the economy, and really it's about the spending on AI. Are companies benefiting from AI? Are the AI companies growing as a competitive? And so
But
we've had
the Fed.
I think for the Fed, it's probably going to be the jobs number. I think they have to look at that. But even then, I think they're in the mode that they're going to close their eyes and say, it's all good enough. We can cut once or twice.
It's funny you say that, because that was my sense of things as well, asking the question. That's not the answer I got. The answer I got still repeatedly was that CPI was important. Ed Hosseini of Columbia Thread Needle was with us just moments ago, and he was talking up CPI being more important than payrolls for the next several months, maybe even the next few quarters. What I'm hearing from Chairman Powell is that he could be willing to move earlier if you see something happen with the labour market and deterioration. What do you make of that, just in terms of the shift in emphasis, if we can indeed call it a shift?
One of our theories coming into this year had been that in 2023, he was happy to cause a recession. I don't think it was his first choice, but if you got a recession, that's fine. There is no way he wants to create a recession in the election year, because that almost hands the incumbent a loss. So I think he is going to be much more cautious about creating recessionary, and that's where I think the balance is tipped this year, too. It's much more about jobs and far less about inflation.
You introduced politics. You think he's worried about the incumbent losing?
I think he wants to be as independent of causing an election result as he possibly can.
Okay.
And so keeping the economy on a steady flow and not turning into recession is probably better for him.
Thinking about politics so he doesn't have to think about politics?
Kind of.
Okay.
Well, your timeline basically says they need to move so they don't look like they care about politics. But the fact that they would be moving so they don't look like they care about politics, they do care about politics.
It's probably pretty hard when, one, you've got Elizabeth Warren writing letters, your boss is the president, and then you've got the former president who is very, active on social media and happy to point out any problems. So get this out of the way, bear the pain, and hopefully, fingers crossed, have to do nothing September, November, and let politics take care of itself.
So a big part of this conversation where we started it was the big rotation and whether it was about making more or losing less. And you said potentially it's about losing less, which should prompt the next question. What part of the market right now, which part of the market do you think is most vulnerable? Because the way we're set up right now, in commodity markets, we've got things that are at multi-year highs. We've got gold that's at an all-time high. In credit, high-yield spreads are at multi-year tights. Equities at record highs. What do you think is vulnerable at the moment? Where are the losses going to be?
So I think it's going to come really from the outperformers. So I think the NASDAQ 100 is the most susceptible. You're going to have some of the individual stocks where now, on individual stocks, they trade leverage ETFs, which seems insane to me, why we would have a single stock leverage ETF, yet it's there. I think it's over $2 billion in market cap. So people are trading this.
It's there because people want it.
Yeah, and it seems a bit like meme stock type stuff. So I think your meme stock, however you pronounce it, but I think those things start pulling back a little bit. The overall market can do well. I think credit's fine. I think credit's very good. I do think, separate from everything else, people should be allocating more to whether it's credit in terms of munis, agency debt, corporate debt, than treasuries. I think if you're running a big bond portfolio, I like the extra spread that you're getting, and you have technically better governance at these entities than now you do out of DC.
Interesting. Pete, you're going to stick with us. That raises a question about treasuries. We'll hit a little bit later on the program. Peter Tchir of Academy Securities. Former NY Fed President Bill Dudley saying another bank run could happen, writing this: regulators have been focused primarily on increasing loss-absorbing capital at the largest U.S. financial institutions. Much less attention has been paid to the problem that precipitated last spring's banking crisis, vulnerability to sudden depositor withdrawals. I'm pleased to say that Bill is now with us for more. So Bill, let's start there and then we can sort of lean into monetary policy as the conversation progresses. Let's start with the stress of the spring of 2023, 12 months ago. What was behind that and what haven't we done to address it?
Well, the problem was that one bank, Silicon Valley Bank, which was very poorly managed, failed. But the problem was the contagion that then generated a whole bunch of other banks. And what we saw at the time was that depositor outflows were much faster than anyone had anticipated. It's the most rapid demise of a bank that we've ever seen in terms of money going out the door. The regulators have been focusing on increasing capital on the biggest banks. They have not been focusing on how to deal with that contagion problem. We need to really build up the Fed's lender of last resort function so it's credible to uninsured depositors so they don't run. And one way to do that is to require banks to pledge collateral to the window, to the discount window of the Fed, equal to all their runnable liabilities. So if uninsured depositors know that's the case, they don't really have a reason to run. It's the contagion issue that I think which was so striking and powerful that we need to address that was evident last March.
Bill, do you think the keys to answering that question, though, are at the Fed or are they elsewhere? I'm thinking more about deposit insurance. Is that something we need to change and maybe change quickly?
Well, you could raise deposit insurance, but that's first of all going to require congressional legislation. The other problem with deposit insurance raising is it basically increases what economists call moral hazard. People are going to be less careful. We saw during this S&L crisis that banks, S&Ls with lots of insured deposits go out and takes lots of crazy risks. So I think addressing contagion through the lender of last resort function, I think, is a better way to go to guard against that kind of risk taking.
Yeah, my question, I guess, would be, while the Fed is somewhat reactionary, my sense is they learned from 2007, 2008 to act more aggressively, much more quickly. Does that kind of fix the problem, or should there be more being done preemptively?
I like to fix problems ex ante rather than after the fact. And we saw a very awkward result in March of 2023 when we had this issue of the systemic risk exception that could only be invoked after a bank failed to insure all the depositors. So Janet Yellen and Jay Powell are basically saying the banks are strong and resilient, but they couldn't actually guarantee that all depositors would be insured because it only can be invoked after a bank fails and only on a case-by-case basis. This is a way of reassuring people that a solvent bank is not going to be subject to, runs that deplete its cash. Basically the reason why people run is it's very inexpensive to run. It doesn't cost very much to run. And you really run if there's some risk that you're not going to be paid off. If banks have enough collateral pledged to the window to cover all their runnable deposits, then there's no reason to run, and you sort of dampen down the risk of contagion right at the start.
Is there any risk we've pushed a little bit too far in terms of some of the regulations where we're forcing banks to have more and more treasuries, which did cause some of the problems in Silicon Valley Bank, but has also really turned the private credit industry around where that's where more and more people are turning to as banks are somewhat restricted or uncomfortable with the current regulations?
Well, you're on a very important point. One way you could respond to what you saw in March of 2023 is dramatically raise the liquidity buffers that banks have to hold. But if you do that, then they have to hold a lot more securities, can make less loans. They become less like banks. They can't perform their intermediation role. So I think, piling on more and more regulation on banks is not really the way to go because it makes banks less competitive, as you noted, with the non-bank financial sector.
Bill, did the deregulation of 2018 have a meaningful impact on the failure of the likes of SVB?
Well, if SVB would have been more tightly regulated if you had had the rollback in terms of the size, the asset size where you were subject to tougher prudential regulation. So that contributed. But I think the big surprise to people was how fast this all happened. Typically, it's taken several weeks for a bank to go from trouble to actually fail. Silicon Valley Bank, it was a couple of days and they were gone.
Bill, let's do a sprinkle of monetary policy as well. Add that to the recipe. Can I talk to you about everything else? Because we're talking about bank crises, and I'm just seeing equity markets at all-time highs and credit spreads at multi-year tights. How do you think this FOMC is thinking about what's happening with financial conditions, beyond just what they look at, looking at equity markets, looking at high-yield spreads? Because when you hear the chairman talk about financial conditions, he says they're tight. When you hear market participants talk about them, Bill, they say something else.
I was surprised by his answer at the press conference to the question about financial conditions. He really didn't want to talk about financial conditions, where in the past he's talked about financial conditions a lot, and he actually implied that the financial conditions were still tight. I don't see that. Stock market's up very dramatically. Credit spreads are narrow. Bond yields are down. Mortgage rates are down. Since end of October, we've had a dramatic easing in financial conditions. So right now there's a bit of a battle going on. The long legs of monetary policy versus the easing of financial conditions. And, if you're trying to figure out what the impulse of monetary policy right now is, you have to figure out what the balance is between those two things. My personal opinion is monetary policy is not really exerting that much restraint on the economy. And that's why the Fed has been on this path of having to stay higher for longer. And I think another aspect of it is that so-called R-star, the neutral monetary policy rate, is probably higher than what the Fed officials are assuming. It's very interesting to me is the Fed thinks that the federal funds rate is going to go all the way back to 2.6%. That's their immediate projection in the long run. But if you look at the market expectations of where interest rates are going to go, they have them coming down to about 3.6%. So there's a 100 basis point gap between where the market thinks the Fed is heading and where the Fed thinks it's heading. And in this case, the Fed is actually a lot more optimistic about the scope for rate cuts over the next few years.
Yep, 3.6 and climbing. Some people talking about 4. Bill, this was wonderful. Thank you, sir. Great piece on Bloomberg Opinion today and on the Bloomberg Terminal.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.